All right, welcome everyone tonight for our fourth talk, I believe. So really happy and pleased to have you all here. And tonight, well, stable, really stable. With the current market, is it really the right thing? Well, let's change that. So I'm very pleased to introduce Shadi tonight. So he's going to give us good insight about stablecoins and also his perspective, because I mean obviously stablecoins can go in both directions, so that's why he's here tonight to introduce stablecoins. And so he's Swiss. He did his schooling in Gallen. He traveled all around the world. He lived in many different places. I heard Hong Kong, Chennai, and Shenzhen, sorry. And then exactly. And then, so doing traditional finance. But he discovered, obviously, blockchain. So this was an opening of creating, with three fellas, I believe, yes. Right? A new company called BrightNode. And so they are specialized in, guess what? Blockchain. And so, so I'm really pleased to have him here. So please welcome to the talk. And so tell us everything about stablecoins.
Okay.
Stage is yours.
Thank you very much. So as Nicolas kindly introduced me, my name is Shadi. I come from a traditional background, and BrightNode, as he explained, is a consulting company which we focus on blockchain-based projects. Either they do an ICO or not. There you can see my co-founder, Michael, and the two other are not here sadly. So tonight we're talking about stablecoins. This presentation will not be a comprehensive guide of every stablecoin there is there, but mostly we will see like what kind. We will classify them in three macro categories. We will see how each category works, and I will give you my take on stablecoins, what I think is the future, what I think their advantages and disadvantages are, and I hope that by the end of the night you will challenge me and say either disagree or agree with me. But so the idea is that I will put everyone up to speed. If you don't know stablecoins that much yet, if you know it, that's great. I can call you back later, and afterwards we can have a discussion. So first of all, if we look at the market now, we could ask ourselves why stablecoins is such a relevant topic. So we look at cryptocurrencies and we see that so far a lot of them have not been used as currencies, but more like investment securities. You see like phenomena like hodl, which, I mean, it can be very profitable, and I have nothing against hodling, but if you think about it, if you hold a currency hoping that it will increase, first of all, you're still thinking about, for example, Bitcoin in terms of its countervalue in dollars. If you're like, I will hold it until it's 100,000. And second, you're promoting deflation, which is good for you once you sell, but it's bad for actual usage, because if you hold coins and you don't spend them, the mass adoption kind of gets stumped. So we're like, okay, cryptocurrencies, the most famous one are. To understand why, we first have to understand what's money. So we're like, money, to be called as such, has to fulfill three functions, which are store of value, unit of account, and medium of exchange. We start with the one that seems most obvious, medium of exchange. This means that money has to satisfy what is called the double coincidence of wants, which means in a transaction, both parties have to desire what the other party has to offer. In a barter economy, this can happen, but it's much harder to make it happen. So for example, if you're a farmer and you go to the butcher, like you have grain and he has meat, you want meat, but he doesn't want grain. So there's a problem. Like, this is very simplified, but as the economy gets more complex, you get a lot harder, like you get more specialized services, which may not interest a lot of people from whom you want a service. So we have money, which is a medium of exchange that's desirable from both parties, under almost any circumstances, and satisfies the double coincidence of wants almost every time. Then we have a store of value. So now fiat currencies and money in general is not the best store of value in the long term, but it's the most liquid one. And money holds its value for a reasonable amount of time. So we could say short to medium term, your money will, unless you are in a hyperinflated economy, your money will not lose its value too much. I mean, my salary in US francs will not lose its value by the end of the month or increase tenfold, sadly. And then we have units of account, which means this is a kind of trickier component. It's you have to be able to quantify the value of something using money. For example, when I say my iPhone is worth 1,000 francs, you cannot get an idea of how much 1,000 franc is. So you have to be able to account, to give a value to your goods using money. And now, first controversial slides. We see, my opinion is that fiat currency, as of now, fulfills all three criteria. Is a unit of account because it's reasonable to price goods and services in, for example, Swiss franc or US dollars. Store of value, yes. And here I see some places. So if you look at strong currencies, solid currencies, they're reasonable store of value for the midterm. I mean, I'm not afraid to hold for sometimes Swiss francs on my bank account. I'm not afraid of losing them, of course. This is entirely different with for example, Venezuelan dollar. Anyway, this point is disputable. And as time goes on, fiat currencies may lose this point. And minimum of exchange, I mean, I don't think I have to explain this. Everyone here would be ready to accept and give me something in exchange for money. So then we go to crypto. In my opinion, it's not a unit of account yet because it's just, for example, I mean, let's say you bought something, you have your lease priced in Ether, and you got your lease at the beginning of 2017. Maybe it's 100 Ether per month. So what's that? And you keep it stable at 100 Ether per month, January 2017, and it goes all the way to maybe already December. I mean, it's still 100 Ether, but it's much more. You understand? So, I mean, there's all this discussion that prices will adapt, but we're talking about high volatility, short-term, intense price fluctuations, which make not impossible, but very impractical to account for the value of goods in cryptocurrencies without knowing what their counter value in a fiat currency is. For example, it's easy to adapt prices in Ether for services if you know how much their value has shifted comparing to the dollar. But if you only have Ether as a reference or Bitcoin, it could be a bit less practical. Store of value, this is another very critical point. I do understand there's a use case for example, Bitcoin as a store of value. That's the biggest currency. A lot of other currency are much more volatile, and I don't think they would make a good store of value. And Bitcoin, I mean, if you got in early, that's great. But if at the end of 2017 you put a lot of your money there, that wouldn't do a good store of value for you. And while everything fluctuates, I think at the time it's still not. I mean, for Bitcoin, I would say it's not there yet. And for other cryptocurrencies, I would say it will not be there at any point. And then we have medium of exchange. This is the point where cryptocurrencies really start to take on, because there's some places where you can pay, where you can use them as a medium of exchange. It's just not their primary use. So of the 3 points, I think this is the one where they got the farthest. And rather than store of value, I would say it's been a good investment for smart traders or smart investors. So now we're like, okay, so you could ask me, yeah, but so why are they so different? How can fiat currency have all these characteristics and be so much better at being money than Bitcoin? And I mean, you guessed, the idea is that fiat currencies are stable. And how do they get their stability? They get it through central banks, which use monetary policy and fiscal policy to adjust interest rate, money supply, the level of inflation or deflation sought. You have like very smart people. One of my ex-professor, his job was at the National Bank, because was just to he was inflationsprognose chef. He had to forecast the inflation rate and set targets for the bank, and that's already the job that one person with all this subordinate has to do. And I mean, that's just one part of it in a central bank. So you have a lot of people that have to work to keep it stable. So we're like, all right, but having a central bank, it's not like it's, how could you say, it's really the opposite of what Bitcoin is trying to do. So how could we achieve a similar stability for cryptocurrencies without having to rely on central bank providing us working on monetary and fiscal policy amongst other instruments? But these are the main ones. And then yay, this bright orange should surprise you, by the way. No, but stablecoins are sort of an answer to how do we make a cryptocurrency more stable, so we're not afraid to hold it in our wallet and use it for daily purchases. So holding in our wallet means I'm not afraid of it to lose value, but I'm also not afraid to spend it today and think, oh my god, a month from now this would be so much more, this would be worth so much more money, so I should just keep it. So we're trying to have something that you're not afraid to spend today and you're not afraid to keep in your wallet tomorrow for the days coming. And stablecoins can be categorized in 3 macro categories, and you could find more, but you have like fiat-backed stablecoins, or as for that matter also asset-backed. I mean, you could have gold-backed, or the idea is that stablecoin gets its value from an underlying real-world asset to which it's pegged to. Then we have crypto-backed. These are weird to say the least. I will present you an example of it, but there tend to be much more complex in terms of technical implementation than a fiat-backed one. And then you have algorithmic stablecoins, which rely on algorithm to regulate their supply and demand, to regulate their supply based on the demand and keep a stable value. So these are different because these two, they have a collateral on which they rely on. This doesn't have one. It's got a target value, but it's, you could say, more decentralized, or it's not tied to anything. So let's jump right in and see a bit more in detail what they are with some examples of these cryptocurrencies. So for fiat-backed, we're bringing Tether, which is famous and infamous. So Tether is very simple in terms of how it works. You have a one-to-one peg to a fiat currency, which is for USDT a US dollar, which is maintained through proof of reserves and requires audit reports. So basically, you pay an amount of dollars to Tether Inc., and these dollars get transferred to a bank, a depository bank, which, I don't know, like they've changed a lot. So the first ones were in Asia, then we moved to Panama. So we had Noble Bank, now we have Deltec. So, but there's a third-party private bank which holds your USD as your collateral. Once you deposit your collateral, you get USDT back, and I mean, it's worth 1 because there's USDT, because they're US dollar in a bank. So the flaws of this system are evident. We will talk more about them later, but basically you have to trust Tether to put your money in the bank, and then you have to trust a third-party auditor to make sure to audit the bank statements and make sure everything is there. And what could go wrong with that? A lot, actually, because there is this. If you don't know this, if you haven't read this paper, I would recommend you. Like, there's no proof that Tether is doing. There is no solid proof that Tether is doing anything wrong, but there is evidence that's, I would say, sufficient to raise and educate suspicion. So this paper, available on SSRN for free, analyzed movements of Bitcoin and paired it with issuance of Tether, and concluded that Tether, there's a correlation between the movement of Tether and the movement of Bitcoin and issuance of Tether. Then another point was the way that Tether dissolved its contract, its relationship with its first designated auditor, Friedman, which was tasked to perform a full of Tether banks. And I mean, it started with confirming the bank accounts, but it wasn't able to finish its audit procedure because Tether said the procedure were excruciatingly detailed and painful. And here we have like a graph that I took from an article on Medium, that did a lot of statistic work on Bitcoin and Tether, and you can see like as issuance of Tether goes up, Bitcoin price also rises. And then we have like this one here is we have less pointers, and things haven't got much better with the second auditor designated by Tether, which is Free Lars and FSS, which, I mean, I have their audit reports here if you're interested. I highlighted several flaws in it, but I mean, I'll just show it to you before because where is it? So if we take a look at this, so the first thing you see is that the auditor is actually a law firm. So this has implication as we go down, as we scroll down. So it did not perform a review using US GAAP, which means, yeah, we checked, which means they checked that there was an amount of money in a bank account, and they matched it with the amount of money the amount of Tether that was issued that you could see on OmniLayer and Ethereum blockchains. But other than that, they didn't do much. And as you can see, then they also advise you, this confirmation should not be constructed as a result of an audit. No representation regarding sufficiency of information. So it's like, yeah, we checked it, but we don't know if it's sufficient, so that's not our business. These are not procedures are not performed with the purpose of providing assurance, limited to findings. So this is a very important point. These are limited to the findings on June 1st, 2018, close of business. No procedures after or prior, which means, doesn't prove anything, but they say they didn't advise Tether, but I don't know, like nothing says here that they could not have provided the money on that day, everything matches, and then everything is back to normal. I don't know what's going on in the bank account. And then also they tell you that everyone, like they got the information from people that were sworn, trusted people, authorized, but then they also say, we assume that. So we assume that the bank for given confirmation were duly authorized to provide such confirmation, and the confirmations were correct. So, it may be standard for a law firm, but you see a lot of stuff, you're like, okay, so how good is this audit report? And the answer is, I don't know. But yeah, so let's go back to the presentation. Oh, it just started again, I'm sorry. So we see there's a problem with a fiat currency. So we see the problems that arise with fiat-backed cryptocurrency, which are like, you have to trust people. You have to trust, let's say you have to trust the company issuing the tokens. You have to trust the bank holding the contra value. You have to trust the local government of the jurisdiction with the bank holding the contra value not to shut the bank down. And you have to trust the auditor. This is not necessarily a problem, because for USD you have some alternatives which at least look a bit more transparent. Like, for example, Gemini, they are regulated under the New York financial authorities. They disclose that they hold their money in State Street Bank. They disclose the name of their auditor, which is an actual auditor. We have USD coin, which is backed by Goldman Sachs. It's issued with the Center standard, and Paxos was recognized by the NYDFS. So, it's not all bad. There's room for benevolent stablecoins, at least on the surface. But yeah, we will have to see. I will get back to these fiat-backed stablecoins in my take on stablecoins. But yeah, so now we jump to crypto-backed stablecoins. These will be a lot more interesting. So the first thing with these stablecoins is that it's for me, it's been so hard to understand just how they work, and at the end of the day, their stability mechanism is still unclear. But basically, what make or die is, so we have some assumptions here to make it clear. Make or die lets you take a loan, which can be collateralized with any asset at the moment. It's called, they only allow Ether, but they plan to expand. So you collateralize your loan, you get DAIs, which are supposed to be stable, so pegged to 1 USD, and you can basically use them as a stable coin. And once you want to cash them back, you pay back your loan, plus a stability fee, which has to be paid in Maker, another token issued by MakerDAO. So MakerDAO is the company, and DAI is the coin. But yeah, you have to pay back this. You have to use some Maker to pay a stability fee, and then everything is fine. So you got your Ether back. In the meantime, you have your collateral, you have your CDP, you owe DAI, you still have your Ether, blah blah blah. So then you're like, all right, so how does this maintain stability? So on their white paper, they say that if Ether goes up in value, everything is fine, your loan is just over collateralized and it's just safer. If it goes down, it can go down just, I mean, they will make it hard, they will make it costlier to produce DAI, so it should stay pegged to $1, but I have to assure, like, it's really, they are not that open on how it works. It's a 4-line paragraph on how it works on their white paper. But although they tell you, they take a good amount of time to explain you the flaws of our system and how will they counteract them. So you could see some problems here. So you're like, all right, so I understand there's a loan and everything, but what happens if, so I understand if Ether goes up, my loan is over collateralized. What happens if Ether goes down and I cannot pay back my 66 DAI, which is $66? When Ether price decreases and it goes below the collateralization rate, which is set arbitrarily at 150 here by me, what happens is that DAI at some point will audit, you will auction your Ether that you have in your CDP to a third party, which will pay them in DAI, actually covering your debt. So you're stuck with your DAI and you lost your counter value. So if you're, yeah. So I'm like, yeah, so I get to keep my DAI. It's great, but yeah, you've lost, if it's 150%, you've lost 1/3 of your value. And I mean, that's basically how this works. And there is some more parts we will discuss. Like, there's also a global settlement if the system is threatened. There is some, we have to go a step back, maker token. So there are some people holding maker tokens which are responsible for governance, which means they set the collateralization rate. They step in as last resort buyers. If no one wants to buy your Ether on the open market and pay in DAI, they have to buy it. And they also get to choose a group of people which hold the keys to trigger the global settlement, which means maker chains freezes, they swap everything back to normal, and everything is closed. I mean, it's like some people can shut down your chain if they think it's dangerous for it. So you see, like, it's weird. I don't think it's gonna, like, I'm spoiling you a bit of my take on stablecoins. I don't think it's great for stablecoins, but DAI, if you're a high-risk trader, has a great, I'm sorry, you want to take a picture?
It's all right.
It's got a great implication. Is any of you an expert in finance? Does any of you do margin trading? Like, one of the use cases they themselves explain and advertise is that DAI provides what is called decentralized leverage. So you can actually trade Ether on margin with DAI, and that works this way. So you have one Ether, which means like 100 USD, and you deposit this. So you technically still have your Ether, but you cannot touch it now. You only have DAI. So you buy Ether, stays at 100 USD. So you have one Ether deposited and 66 DAI. You use your 66 DAI to buy 0.66 Ether. So you are now exposed to Ether by 166 times. So you paid $100 and you bought $166 worth of Ether, which is great. If Ether goes up, you get the profits 106. So you get a 66% margin on your profits. If thing goes bad, you have an under collateralized loan and a decreasing counter value. And I mean, it's just like margin trading. Everything can go bad, but it's kind of cool that you can get decentralized margin trading. You don't have to rely on an exchange or a broker to get a loan on you. So that's as far as it goes for DAI.
Is it already in production?
Yeah, I mean, Maker token is already trading and DAI is already in production, and I'm not sure how reliable is this, but there was a guy making fun of DAI on Twitter saying they had a peak of 77 users on the Ethereum blockchain. I don't know if it's true, if it's a joke. I didn't check myself, but yeah, this one is live. Okay. And then we have Algorithmic, the last one. It's algorithmic stablecoins, Basis in particular. Basis is technically simple, yet very complex. So it relies on the quantity theory of money to get stability. So it sets it has three key components. Like it issues three securities. You have basis tokens, which are the dollars, the one that are pegged to the US dollar or to the value. They have basis bonds, which are bonds with bonds, like, because, and we will get to why I'm saying bonds later. And then they have basis shares, which act like securities, although I'm not sure they are regulated. And then you have a target rate, which is, right now they're targeting 1 USD, one basis token. They say in the future, once, if ever basis takes over the USD, they will peg it to a CPI, so a basket of goods, and make sure the purchasing power stays constant. So how does basis work? Let's say the demand for basis decreases, and so basis starts to be worth. So the basis is depreciated against the target rate of $1. How do we make it worth a bit more? We constrain the supply. So basis will issue bonds at a discount, so maybe 80 cents on the dollar, to some bondholders. I mean, these are people, it's any actor in the market that will become a bondholder by purchasing the bonds. He's gonna pay with some basis tokens he has, thus actually giving up some of the supply he holds. He gives it back to basis. It gets destroyed. I mean, much as like, this is similar to how a central bank operates. It issues bonds, takes back fiat liquid money. The supply is constrained. Wait. Did I actually swap it? Yeah, I swapped this. I'm sorry, this one I swapped it last time. There is a mistake in my slide, and this one should go on this one here when they have to decrease the value. I think there's been a miscal. Anyway, so picture this shareholder on this one here, and I apologize for it. But so this is basically how basis increase its value. When basis is too strong, what do? We inflate it. So we put out more basis, and as long as there is people that bought bonds, they can sell them back for a premium because they bought it sub money. So they bought it at 80 cents on a dollar, and they get to sell it at $1 on the dollar. So they instantly have an incentive to sell it. Is everything clear on this? Okay. So once there's no more bonds to be bought back for basis, what happens? Basis gives out dividends to shareholders, which means these people get the excess money. And here it gets interesting. Who are basis shareholders? Shares in basis are given out at the Genesis block, which means shareholders are predetermined, and they will most likely be the VCs that have backed basis in the beginning. So basis has raised 130 million in private VC funding, and if these VCs get to keep the shares, they basically have invested in money printing machines, because if, as they expect, basis market cap will go up, there will not be as many bonds to be bought back, which means they'll only be left with the chance of paying shareholders dividends, which means the initial supply will go to the shareholders, which can then sell it to the open market. So yeah, you have invested. So I'm not sure if Bain Ventures and Google Ventures have invested because they really like the project, or they put 130 million in money printing machines. But I mean, this is what you can do for a shareholder, and everyone gets it indirectly. Then when everything is done and everything is fine, and there's lots of bonds circulating, it may be fairer. But yes, and there's a catch: basis bond expire. After 5 years, your bond is worthless. So they don't expire like a normal bond. It's not an obligation towards you. It's like you purchase this bond, and within the next 5 years, if we need to increase the supply, you get to purchase it. You get to sell it back at a premium. If in 5 years there is no need to increase the supply, we don't have any more obligation towards you.
It's more of an option.
Yeah, they call it bond, but it's an option. And is everyone clear on basis? Because I mean, these two, they kind of get complicated, and I had to read a lot about them. So before we jump into the discussion, is there any question left on how they work?
I have one question, maybe it's for the discussion, so tell me about the Tether case. I still haven't found out how, actually if you go one slide back, I haven't found out how tethering actually makes money. Because they collateralize one-to-one.
Okay.
They don't make any money,
So
but they have to pay their infrastructure, they have to pay the auditor, etc.
yeah.
Do they charge fees somewhere for
So
some transactions?
They're probably doing arbitrage. They sell the
I mean, if I can interrupt just one second, just it's not because I don't think, but if we want, like
Can
we
go
have
back to the discussion?
no, because we have a part of the discussion will be focused on how the stablecoins make money.
Perfect.
So I mean,
So
you
let's
can
get
finish
into
your
question.
no, you
I
can
think we have someone in the room that actually created stablecoins. So
yeah. I mean, if you want to finish your explanation or you want to save it for later, it's just so that we get on.
I mean, arbitrage is basically differentials in price, right? So if there is a token where the net asset value is supposed to be $1, but it's traded at somewhere differently than that, then you would be buying the less valuable one, you would be selling the most valuable one, and you would capture the difference. So probably one thing like that, or just a scam because I don't believe in tech.
Yeah.
We will get to that.
But I'll ask more questions later.
Yeah.
It's fine.
So we get to the discussions, and discussion will go like this. First part is our take on stablecoins, which is again divided in two parts. First is my take on stablecoins, then your take, and then we go to the great question. I mean, we can actually, like, in your take, we can also, yeah, it's fluid. Discussion will be like fluid on that. So what I think about stablecoins. Fiat asset-backed stablecoins right now are widespread, easy to implement, because from a technical point of view, they don't require super sophisticated contracts, which is not a bad thing, actually. It holds important points of failure that have to be addressed, or how could you, I mean, you have to be careful. They require more attention because you have several points where one actor could potentially bring down your stablecoin. So you have to be careful, you do your due diligence and make sure like the bank is trustworthy, the financial institution is trustworthy, they are compliant with laws. I mean, if all of this is given and they are transparent, there's no, I mean, in my opinion, there's nothing to fear about it. However, you have to watch out for them. May eventually disappear. This is related more to fiat, because I think, and this is my opinion on which I'm sure someone will have something to say. So, asset-backed stablecoins will be more interesting. Fiat-backed stablecoins, I don't think it makes sense in the long run to have a private company manage, like, let's say they overtake the US, like something like USDT or USDC overtakes the dollar in terms of usage. Does it make sense to leave all of this to a private company with a private bank, or would it make more sense for fiat-backed stablecoins to be issued by central banks, or DLT? Because at the end of the day, the stability of the stablecoins is still decided by is still determined by the central bank's policies. So it's if it's a fiat currency, it's not that decentralized. It's stable, but you're not getting rid of a central bank. Asset-backed, it's another matter. Crypto-backed, it's complex and unclear for me. It's not suitable for stablecoin purposes because it's unclear. I'm not sure they can achieve real stability without manipulating the market or do wash trading or something like that. Yeah, I mean, yes, but they're not yeah. I mean, you could say they do it for good, but yeah, this is a problem. This is more of a philosophical problem than a practical problem, I would say. I mean, you do need to, but no, I agree with you. They manipulate, you could say manipulate, but they also adapt it to market conditions. And you have this idea that central banks should act in the interest of a greater good. So, I mean, they have more insights. They're probably more scrutinized than some private company that are not registered within a region. But yeah, your point is correct. But at least you understand, it's easier to understand how a central bank works. I mean, if you study macroeconomics, you can understand how they do with their fiscal policy, how they do with their monetary policy, contractionary, deflationary budget. Blah. So That's it. But they have this interesting application with decentralized trading, so there might be a use case for them if some high-risk crypto traders do like it. So you mix Italians with potential profits. It would be a use case, I think, for them not to disappear completely. Then we go to algorithmic, which is decentralized, like you see, basis doesn't technically rely on any peg and any bank, so it's decentralized, but you have this highly elitist shareholder structure in which the one that get in first have massive advantages. It doesn't deal with fiscal policy. I mean, that's something for the government to do, but usually you try to make them work together. It's solely relying on the quantity theory of money for its stability. Now, I don't want to get too technical, maybe some people know more than me, but the quantity theory of money has been already challenged sometimes. It's not wrong per se, but it's not entirely, cannot entirely explain. Quantity theory of money, for anyone that doesn't know what it is, it explains that the price, the value of a currency can be influenced, in very simple terms, can be influenced by the quantity of money that's produced. There is Thatcher and Reagan during their administration, they tried to apply quantity theory of money principle to their economy. It's been said that it doesn't really work great. So, I mean, basing your entire stability mechanism on this theory is generally an oversimplification of macroeconomic problems. So I would say coding a smart contract that can code the complexity of everything that goes on in the macroeconomic field to keep a currency stable, I think is still beyond, it's for sure beyond basis, but it's for now it's beyond, I think, everyone, because it's really hard to code the human behavior, the human capacity to react to unprecedented event, to manipulation, to dishonesty. I mean, all it does is keep a coin stable to a peg value arbitrarily chosen. And by the way, there's another problem with the target rate determination is how do they determine the target rate? I didn't get into this, but they have a system of oracles that will take the target rate and plug it into the system. Where do they take it from? On their white paper, they propose several options. One is just to take it from how the coin trades on exchanges, like how, let's assume Coinbase lists basis. Like, how is basis doing here? Is it like, is demand higher than the supply? How are we doing? Okay, we take this, we feed this into the smart contract, we feed this data into the company. All right, now they know they have to decrease their value, and then so there is a great there was also a voting process on which every 5 minutes they had to agree on a value. So, I mean, these over-reliance on oracles to get an arbitrary rate, it's a potential point of failure for base coin. But I would say the biggest problem are their oversimplification of macroeconomic problems and a shareholder system that technically turns a limited number of shareholders into money printing machines through which everyone has to go to get their basis coin, at least at the beginning. So what's my take? What do I think about them? So this is not investment advice, but don't buy as a stablecoin. Stay away from crypto-backed ones. I think algorithmic are interesting for their concept because they're kind of cool. I wouldn't touch them, but I think the idea, we need some kind of experimentation in this area. And where should you go? Like, I think their safest bet is to find you a transparent, for the time being, a transparent and well-implemented fiat-backed stablecoins. I think they will help in mass adoption at least, and they will be useful as a base value for other cryptocurrencies that fluctuate more. So that's kind of my take, and what I said, generally speaking, having a single currency controlled by some transparent companies to use for different economies seems like a bad idea. Now, your point is central bank may also be intransparent, yes, but as I said, it could be. This part doesn't say that every stablecoin is a bad idea. Just to clarify, I'm saying if you want to substitute every national currency with a stablecoin, that could be a bad idea if you have it issued by a single company. Having several stablecoins, asset-backed stablecoins, some competition is not bad. This is really related to not having any other currency, just stablecoins. So I think this is tricky, and we should be careful with that. So that's my take. Now your take, please. You are free to disagree with me and have some questions.
Well, thank you. So I guess we can go to the panel. So I want to introduce also Thierry here. So he's a commodity trader from experience and background, and now he's full crypto, and there's a lot to say. So we just had a
not a lot, because I'm trying to be short and try to get as much as
go ahead.
Yeah, I think everyone can hear, right?
Yeah, that's good.
So, but I have a couple of things. First of all, many central banks are private entities on first place.
Yeah.
Second place is they do have a quantity of money and a lot of things with interest rates that they play with. One thing is Taylor rule, and then basically monetary mass and money supply and how they deal. The thing is, most of them tend to say that they follow certain rules, and then all of a sudden they don't. Particularly when it comes to quantitative easing, asset purchases, etc. So when you actually look at the way they portray themselves compared to what they actually do, what you would find is that if they were really sticking to their guns, they would basically create a consensus where the rules would be kind of in an algo type, where they would be like, look, we're very transparent about what the rules are. If the inflation is this much, if unemployment is this much, if the monetary supply is this much, if the velocity of money is this much, then that's how we would act, and they don't do it because essentially they're trying to break the natural business cycle of when there is a downside, they just pump money, and then that's it. There's only as much times you can do that, because now we see where zero interest rate, they have no tools left, and so they're buying assets, and even having an interest rate that doesn't fluctuate with the market, but is rather manipulated by them, because they arbitrarily decide what the price of money is. They arbitrarily decide what the price of assets is now, because they're essentially buying assets like the S&B, right? The S&B Swiss National Bank, which is a private entity, by the way, spoke to them as well, and they say, look, we're just another one of those for issuing private money. I am intending on issuing private money. I'm very clear about that. I do have a system of audit where I publish the audit, and where you can redeem the gold. So in this case, it's gold. So what I think was missing on your three cases was a third one, which is asset, and you mentioned it. And but also, like I was asked, like, what do you think the future of money is? And I think in the future we won't be having money per se. We'll be all plugged into the matrix, and we'll be essentially trading in time and energy, which is really something you cannot quantify. So when you talk about stable coins, there's two things that come to my mind. One is stabilizing, meaning that there is a consensus on the price. Okay, like you said, it has to be unit of account, store of value, and medium of exchange. In my case, I would like to add also intrinsic value, because if you don't have intrinsic value, then the store of value problem is very hard, and you would challenge to say that any fiat currency fills that role, because essentially in 100 years time you always see a default. Most of the time you can Wikipedia defaults of sovereign government. You won't see 100 years with a currency that is stable. Most of the time you already have 2% inflation, which puts you at 0% at the end of it. Exactly. So it's only a matter of time when the minute you have inflation. So store of value is already a fail on the fiat currency, and the key word on fiat currency is fiat, right? The whole point of having Bitcoin on the first place is that you don't have. It's not a fiat. Supposedly, it's because fiat means it's not backed by anything, but by trust, and in that way it resembles the algorithmic side. So when you remove the fiat side, I mean, look at the track record of history. 3,000 years of evolution. You have gold standard. And why is it gold standard? Because gold in the periodic table is the only chemical element that is immutable in time. In other words, it was immutable before it was cool, right? And what Bitcoin attempted to do is to have the same. I come from the commodity trading background, so I know how much it takes for you to mine an ounce off the ground. It takes you $1,000 at certain periods. So you have the face value. You say, okay, it must be at least $1,000. For Bitcoin, is basically the hardware, the energy you put in. The hardware, as you might know already, electricity rates are more or less stable depending on the countries, but the hardware, there is a progress on how many computations per second you can do with the hardware. So the hardware essentially at some point gets obsolete, and very quickly actually. So the mining rigs and all of these mining companies, very hard to maintain because they're probably going to collapse. The high machinery to mine an ounce of the ground, it's the same thing. The track record is different when it comes to gold. The only problem is it's centralized. It's centralized because you and I are centralized. We're bones and flesh, and that's what I was talking about. Like so far discovered, we only have a centralized way to say, okay, well, in 1,000 years' time, I will be back with my ounce of gold, and I will return that. And it's not practical because you cannot divide it, so the unit of account for gold is bad. But now that we have blockchain technology, you can have a unit of account provided you can bridge the gap between the real world and the technical world. The problem I have with Bitcoin is that Bitcoin, because you can fork it and you can create as many as you want, and you already see that there's, in 1,000 years time your Bitcoin is obsolete. So no one cares about your shitcoin or whatnot, because essentially they're all shitcoins for me. Unless it's a protocol, and the protocol for me, I see it as an Apple store, and I'm just an app, right? But then they're all protocols, right? So, and some are more decentralized than others, some are more private than others, some are more anonymous than others, some are more secure than others, etc., etc. But they're all protocols. If you try to say that your coin is basically money, then you have to put some value in it behind. So unless everyone is transacting in that because we all decentralize in some sort of non-physical world, then it works. But we're not there yet. And so that's basically my point as I speak today. Now, I'm not going to pitch my book because it's going to be out in after, and you probably see about it. We're pushing 500 million Swiss francs worth of gold, and it's in a vault. It's in Switzerland. We have 3 ledgers. One ledger that does the audit. We publish all of the audit pieces, the purchase receipt, the assay card, the bar number, everything on the ledger. We have another ledger which is an ERC20 token, which is basically a token everyone creates, but we say that is the legally binding ownership of that gold. You can redeem it. So not only there's an audit saying these are the bars that we have, these are many tokens, so naturally there's 1 gram, 1 token, but you can also like kind of shit test us by saying, well, we want you redeem 1,000 tokens, you say we want that bar, and so you have another kind of a random selection of bars, and then if we default on giving you the bars, then we're pretty much screwed up. And then I would say for this point that private companies do care about the reputation, at least in Switzerland or anywhere, because if you default for one customer, in this case, I mean, in my particular case, I would default with everyone and I'll be screwed up. Mm-hmm. I was trading commodities back in 2012. I was trading also with Iraq, and they were selling oil. You couldn't purchase oil in Iraq with US dollars because there was an embargo. But you could barter trade it with gold. And that's very important because that means it's outside the government's realm. And I think that's also the philosophy behind Bitcoin, is that your government cannot decide all of a sudden say, oh, Tether, subpoena, and then they're all screwed up. And that can happen to absolutely any fiat currency. The government can decide arbitrarily, this is not okay. And any related crypto business is just going to disappear, and then it's a legal tender. No one controls gold as a currency. They're not like the whole gold of the universe is not owned by one particular company. So that's why I pick gold. So I think it's not rocket science for me. It's just like I'm just doing a continuity of this. But when you look at the 3 models, fiat is fiat, so it's basically crap. Long-term expectancy of your store value of this is 0. Don't give fiat to your kids, right? I mean, family offices in Switzerland, why do they own gold here? They must be doing something right. Fiat is crap. They're always subject to default. One of the things I always say about fiat, and particularly retirement, is that when you're retired in Europe and your fund is not a real fund, it's just a big hole of debt, because that's how the governments finance themselves. What you do is, okay, I'm the government, I want to screw you. What I say is, I'm going to put the maturity 30%. So let's say now before you retire at 66, now you're going to retire at 69, because there's an actuary that says that if you retire by 69, 30% of the people will die before they retire, so you already remove 30% of the people you have to pay for. The second thing is, by the time you retire at 66, your $1,000 that you were expected to get, okay, has a purchasing power of about 30% less, right? And then the third thing is, well, you end up like Greece eventually, and they say, you know what, we're not going to give you $1,000, we're going to give you $700. So you got 30% plus 30% plus 30%, you're basically screwed. And that's really what happens. So fiat, forget about it. Crypto is basically shitcoins over shitcoins and shitcoins. If it's not a protocol, then there has no use here, because you can fork it as many times as you want, and what you end up doing is you're recreating fiat. Because if I can create as many as I want, I'm just fiat. So it's just really like the trust you have in it. There is no backed. Crypto backed is basically backed by thin air. And algorithmic is something that, strangely enough, to me resonates like central bank stuff, because essentially they just print money and they say, oh, people still want to take it, so I guess I'm the Swiss National Bank, I'm going to start buying equities now, put interest rate at 0 or negative, which is, when you look at economically, like negative interest rates is just an abomination of nature, right? You cannot possibly do that. You do negative interest rates, you're basically punishing hardcore the savers, and you're incentivizing bad behavior and stupid debt, which essentially what brings you in the long term is you're punishing good behavior. It's a moral hazard. I mean, it's almost like philosophically, it's a moral hazard, because you're basically rewarding bad behavior and big debt, and you're punishing savings. You do that for a long enough period of time, you don't have savings, you cannot possibly have investment. You need to have saving before you invest. So essentially this is shooting yourself in the foot, and long story short, it's going to end up badly. I mean, we all know that this is just central bank really like kind of experimentation. So to me, like in this box, I would say I would add the box of assets, and then for assets you need to find out one asset that has the intrinsic value, meaning a consensus, because essentially that's what you're looking for. For stablecoin is number one, and most above all is consensus, is what is valuable in the consensus of the people. And this is not me, it's not you, everyone has to decide what is valuable for them. And I think time and energy is most likely the most valuable. The reason we use gold is precisely because you want to have a vehicle to reflect that time and energy that you put, so that my time and my energy is not the same worth of your time and your energy. That's just that's just the truth. I mean, okay, you can be socialist about it, but it's the truth. My time is not the same worth as your time, and so you gain skills, and then people have different prices for the hour, right? But in the end, you have to reflect it through a vehicle, and that vehicle has been gold, not because of I say it, but because the 3,000 years of monkey people just figured it out. Okay, so I'm not a genius; I'm just copying that. And so I would say the intermediary step would be probably that, right? Until you end up doing the same mistakes as in the past. And then perhaps one day when we all Skynet and something, then we could go back to crypto back, but in the sense of we all plugged into the matrix and we are not centralized anymore. Because so far we're centralized as human beings, so we need to eat centralized food because they're physical, and so you need to have physical stuff to show for. Once you remove that from the equation, which God knows what's going to happen then you can speculate about any sort of consensus of time and energy depending on who you're speaking with, and reputation and skill. But so far discovered, I think there's no better than gold and silver, and that's why it was only until 1971, a Nixon shock, that you don't see that. But really 71 is not so long ago, and you can consider probably our kids or in 1,000 years time, people will be looking back and say, you know, this is an abomination of history, or an anomaly, and this is not okay. You know, was just like they tried it. Well, nice try, but it doesn't work. Right? Petrodollar doesn't work because energy is switching. I mean, there's a lot of different things, right? I mean, you cannot store food for too long. I mean, you name it. There's plenty of reasons why it's the way it is. The one thing I think a lot of people, including on the crypto back and the hardcore Bitcoin believers, would think at some point, because they believe it's going to stabilize and there's going to be a consensus on the Bitcoin, which is, you know, fair enough. I don't know if I'm right or they're right. But what I do believe and where I can find an agreement with these people is, well, you know, let competition be, right? And essentially people will say, all right, I believe in Bitcoin, I believe in this, I believe in that, and essentially the best one will win. That's really kind of my take on this, if I may say. So.
Well, thank you. So in fact, that would be like, we all know that central bank is rigged, so introduce from the back door an alternative, something like this.
Well, you know, the thing is, most of the government's problem are usually sorted by the private sector, right? So, you know, the more government you put, and I think it's quite ridiculous when, again, you have to remove yourself from the situation and think, why is it that a lot of interest rates in the bond market, normal bond market, the interest rate is defined by the market, right? And otherwise it would not be capitalism, right? And so why is it that everyone else has those rules except for money? Why is it that money doesn't have a floating interest rate also defined by the market? And the reason for that is because the central bankers and the authorities, they don't want to see a boom and bust cycle because they don't believe in the creative destruction, right? They don't believe in basically Schumpeter's law. They think that they can curb the economic cycle so that when they start seeing a recession, they can stimulate to launch another wave. But that, like I said, has a moral hazard because you're basically letting bad behavior prevail. If anything, you're rewarding it in the long shot. So by not letting the bad behavior or the poor suckers die, you're basically incentivizing them. And that's a big problem in today's world, right? I mean, it even kind of links to human population. I don't want to go into that, but that's really what it does. It's a bad system that rewards bad behavior. And bailing out a bank that has been screwing up people, for example, is not it sends a message, right? It sends the message that some people stay unpunished and some people don't. So in any event, it's not really.
So-called Austrian school.
Well, I'm an Austrian. I'm an Austrian in terms of you know, School of Economics. I'm kind of like a libertarian. Like I'm not a demand side economics. I'm a supply side economics. And the reason for that is because philosophically, and this is like really esoteric, is that it's very easy to demand for things. I want this, I want that, I wish the government gives me this and stuff for free. But stuff for free doesn't exist. Someone ends up paying for it, right? And most of the times it's the next generation, right? So if you want best generation for your kids, it's the last thing you want to do. The reason I'm an Austrian supply side economics is because it's a lot harder to provide with something and make it so that people have a demand for that. You essentially create demand by providing a thing that is so good that everyone wants it. But it's a lot harder to be on that side and actually produce than to be on the other side and actually demand. Because if I'm a politician and I say, I'll give a free Ferrari for everyone like Maduro, right? It's a lot easier to get elected than if you say, well, you're going to have to work your ass off to have it, right? So it's a philosophical question, right? I think we in Switzerland here is been doing pretty well, and the major point of that is because you have responsibility linked to your decisions. You cannot blame the government of making bad decisions because the bad decisions you made them by direct democracy. So if you say we want a free Ferrari for everyone, or like the other time where they were like universal basic income, which was completely stupid, it would have been like, okay, you morons want that? There you go, 1 million for everyone. And then what happens? Well, prices increase, and more so, the ones who end up being punished are the ones with the basic goods because everyone buys a Ferrari now, and then all the inflation pushes up every prices, and everyone's a millionaire like in Zimbabwe, right? But then at least you have responsibility. You suffer from the mistakes that you made directly, so you cannot say, this moron chose for me, and then now we're in the shit, because you say like, well, you're the one who chose that, so you have your destiny in hands, and then what you ultimately through trial and error you end up having is people don't want taxes, because they rather pay for what they need and not pay for the neighbor, right? Which is, strangely enough, it's a lot more cohesive as a society, because you assume that everyone that has something works for it, as opposed to in France, where I lived in France for a couple of years, and they would have replacement of a work, family, and basically country by state. And so the state will be the one who works because they provide you with work. The state will be the family because you don't need to take care of your grandma, because the state will take care of it, and the state will take care of the countryman, right, the poor guy. And what you have is actually the opposite effect, because now people don't care about their families, and in 2000 a lot of old people died because they weren't being taken care of. And then the third thing is that, well, people are sick and tired of paying taxes, and they blame it on the poor guy. So they say, hey, why would I help you when you're down if I'm already paying my taxes? So what you actually have is anger towards those poor people when they should be helped. The other country I come from is Mexico. Over there, you don't work, you die, right? It's simple as that. It's the other extreme. But you would find in Mexico that a lot of people, precisely because they know that you have ups and downs in life, and then you go through periods of life where you have nothing and periods of life in which you have more, but you know that the poor guy in the street doesn't have this welfare, so you're more inclined to help him actually. And you know that if you don't take care of your family, no one will, so you have to take care of your family. And your family teaches you that, because if you don't take care of all of these things, then when you're in difficulty, no one's going to take care of you. So there is a cohesive system in actually being like that.